Mortgage Minute today being brought to you by our friends at Geneva Financial. When you're ready for that next home loan, Geneva's got the programs and the products. You just need to make the call, 800-306-1990, 800-306-1990. Let's take a look, see what the markets are doing this morning. The S&P 500 are basically flat, up 0.65. The mortgage-backed securities, they're down 45 basis points. That is painful. If you remember our broadcast yesterday, when the mortgage bonds go down, interest rates go up. 10-year Treasury is up 11 basis points this morning. That's a massive move on the 10-year Treasury. Why is this happening? We're always looking for the reasons why. Actually, before we get to the reasons why it's happening, let's just tell you that with that bond down, and it's down 45 basis points. Now, we every Thursday morning, 7 o'clock here in California, we get the Freddie Mac Mortgage Market Survey. And the survey is done Monday through Wednesday. That's how they do it all the time. So they do their survey Monday through Wednesday. They come out with a survey, and they report the results on Thursday. They do the survey Monday through Wednesday, report the results on Thursday. The 30-year fixed rate mortgage, according to Freddie Mac, 5.11%, and you had to pay 8/10 to get it. Now, you know that I give you the exact number every morning, or most mornings, from OBMMI. They provide the most comprehensive, accurate, timely, and interactive analysis of pricing ever conducted in the mortgage industry, calculated from actual locked rates with consumers across 35% of all mortgage transactions nationwide. Loans yesterday actually locked 30-year conforming, 5.324. That's the 30-year conforming number. So, yes, Freddie Mac did the survey earlier in the week. They came up with a 5.11, but the real number is 5.324, 5.324. But you may be able to get some of that stuff. You probably can't get the OBMMI. They don't. That's not a public number, or it's not as widely reported. But the why question is, why is all of this happening? Well, as we've told you right along, it's inflation. Big problem, and the Federal Reserve knows it. Now, if you listen to the Fed speakers, men are saying that they believe we can achieve a soft landing. Now, do you believe that? Yeah, right. Does the Fed ever come up with a soft landing? That means that they can tighten while not causing a recession. Hogwash. Charlie Evans and the Blackstone CEO mentioned the issue of wage and price spiral. This means that as inflation goes up, goods cost more, people demand more wages. But then those higher wages cause more dollars chasing fewer products and cause more inflation. This spiral can be problematic, especially with the supply chain issues that appear to need much more time to sort out. There's also a story that came out regarding the jet fuel shortages in the Northeast. Think about that one. Running out of jet fuel out there in the Northeast. Don't plan your trip to the Northeast this summer. Might cause even more problems. Now, everyone's talking about the recession, especially as the Fed is hiking rates. Likely, again, 50 basis points at the next few meetings. Does the Fed know what they are doing, or are they crazy? The only thing the Fed can do to curb this rapidly rising inflation is destroy the demand side of the economy. And while the Fed will never admit this, their plan may be to cause a recession, because it's the only thing that they will effectively reduce inflation. The last time the Fed hiked by 50 basis points, that was in the year 2000. We had a recession in less than a year. And a couple of the Fed speakers are actually saying right now they think that we should be raising 50 basis points several times this year. We're at a 0.25 Fed funds rate, and we're heading to 3.5 if Fed voting member Bullard has his way. So 3.5. What does that mean? What's that going to do to issues? So here's the fact of the matter is, as people are watching this increase going through, the big money, the capital expenditures, the big corporations that put a lot of money to work and investment, they're going to have to start doing a double take, because a lot of times they're borrowing at about 6 points above the Fed funds rate. So if they're thinking about borrowing right now at 6%, 6.25%, which is about that 6 over the Fed funds rate, well, by the time they get there, you might be looking at 9.5%. Might give them a reason to think twice. And if you listen to our broadcast yesterday, one of the comments or it might have been the day before, one of the items that we were contemplating, one of the items that we've been talking about is strategic refinancing. Strategic refinancing. Now, if you're looking to do a rate and term, no logic in doing that at all right now. Unless you did a purchase money loan with a home equity line of credit to cover whatever reason you had for it. That purchase money home equity line of credit, you may want to consider rolling that into a new loan right now. Why? Because it's considered, well, a purchase money isn't, but if you have a home equity line of credit, it's going to go up. The interest rates on it are going to go up. So, and if you're doing a cash out to pay off bills or do home improvement, that's going to be considered a cash out refi. That's what you did with the home equity line of credit. Now you roll that into a new loan right now. Yes, I understand the interest rates are high, but 6 to 12 months from now, when we are in that recession that we've been talking about, and we've been sharing the idea that we're going to go into a recession. It's about a year now that I've been saying, not a year. It's been since the end of last year that I've been saying we're going to be seeing a recession end of 2022 or the beginning of 2023. When is it going to happen? I don't know. I don't have the exact date. But what I do know is we're on our way to it. And with that being the case, the strategy is pay off your debts now, take out some of the equity from your property. Maybe even you want to buy another property. Take out as much equity as you can right now. Even if you're just putting it into a safe, secure investments. If you don't know of any, I can tell you our friend Todd Halterman has some great ones that you can get a hold of. And get involved in a safe, secure investment, or, I know FINRA doesn't like me to say that, or buy another piece of property that you can use as a rental property. Then when we get the recession and lower interest rates, you restructure the loan, because now you don't get that hit for being a cash out refinance. You actually get to do a rate and term loan because you've already did the cash out refi. Now you felt that pain for a short period of time, and you restructure into a longer loan for a longer period of time. That's a strategy that we constantly share with people, because we're not looking to just be a mortgage company, mortgage originators. That's not what we do. We are liability advisors. We want to look at saying all the different liabilities that you have. How do we manage those? Why? Because once you've got your liabilities under control, you've got a better opportunity to save more and more money and maybe have that safe, secure retirement that maybe you want. Some of us like to work. I enjoy doing the radio show every morning. Maybe if I can get up a little later, that'd be nice. But getting up here, coming and talk to you each morning, got to love that one. That's the Mortgage Minute, brought to you by our friends at Geneva Financial. When you're ready for that next home loan, Geneva's got the programs and the products. You just need to make the call, 800-306-1990, 800-306-1990.